How does insurance handle joint and several liability? Have you ever wondered what happens when multiple drivers are involved in an accident? How does insurance deal with the situation when more than one party is at fault? Let's break this down. Joint and several liability is a legal principle that comes into play in these scenarios. It means that if several parties are responsible for an accident, an injured person can claim full damages from any one of those parties. This is true regardless of how much each party contributed to the accident. For example, if two drivers are involved in a crash, and one driver is unable to pay their share of the damages, the injured party can seek the entire amount from the other driver or their insurance company. This ensures that the injured person does not have to chase multiple parties for compensation. From the perspective of auto insurance, this principle has several important effects. First, it allows the injured party to receive full compensation without dividing their claim among different insurers. They can collect the entire amount from any one responsible party's insurer. This is especially helpful if some parties do not have enough insurance coverage or assets to pay their share. Now, what happens when an insurance company pays more than its insured's share of the fault? This is where subrogation comes in. The insurer that paid the claim can seek reimbursement from the other responsible parties or their insurers. However, if those parties cannot pay, the insurer that covered the full amount may have to absorb the loss. Joint and several liability also affects how insurance companies handle settlements and litigation. Since one party can be held responsible for the entire amount, insurers often prefer to settle claims quickly. This helps them avoid paying more than their fair share in the long run. They carefully evaluate the risks associated with joint and several liability when deciding whether to settle or go to trial. Another aspect to consider is how joint and several liability can impact insurance premiums. If a driver is found liable under this principle, their insurance premiums may increase, especially if their insurer ends up covering a large portion of the damages. It is important to differentiate between shared liability and joint and several liability. In shared liability, compensation is divided based on each party's percentage of fault. In contrast, joint and several liability allows the injured party to recover the full amount from any one responsible party. This can lead to insurers paying more upfront and then seeking contributions from other parties later. In summary, joint and several liability shifts the financial risk among insurers and at-fault drivers. It protects injured parties by ensuring they can recover full damages, regardless of the financial status of each responsible party. For insurers, it creates a complex situation where they must manage the risk of covering more than their insured's share while pursuing other parties for reimbursement. Understanding how this principle works can help both policyholders and insurers navigate claims involving multiple at-fault drivers, ensuring fair compensation for accident victims.